Hello traders, it is Sunday, March 2nd, and it's time for our weekly video. The theme today is Set the Trap. What trap? What are we talking about? The market's been selling off really hard. We got a big bounce Friday. We knew that a bounce was going to be coming. The nature of this bounce is going to tell us when we need to start taking short positions. And yes, we will be taking short positions. We have evidence of a technical breakdown. The table is finally set. So let's take a look, as we do with all of our videos. We take a look at our previous picks. A week ago Sunday, we had this big market sell-off on Friday, and this is the price action on Monday. As I'd mentioned to you, on Sunday, a week ago, BAC was my short pick of the day. We are only going to take that short position when the SPY breaks below the 50-day moving average. And that's exactly what happened on Monday. So we get that crackdown. And you can see that BAC was trying to get through VWAP, couldn't get through VWAP, and finally collapsed later in the day. Tuesday, we get this tiny little bounce, and then the bottom falls out. That was a really nice trade. And here's what the market did during the course of the week. You can see nice, steady downtrend. So here's your price action on Monday with that little breakdown below the 50-day moving average. And then there's one of your nice big drops. You'll notice on this SPY chart that the price action is very choppy. Bull markets die hard. If you've watched my videos, you know that I constantly pound that home. We should expect lots of volatility and bounces like we saw on Friday. Wednesday, I posted a video before the open, MSTR, and I gave you specific instructions on how to trade that. We didn't have any bearish price action on Wednesday itself, but on Thursday, the stock had this gap up and this gap reversal with a nasty round of selling right out of the gate. You can see here, you draw a horizontal light, you take out line, draw a horizontal alert line. You take out the low of the day right here, and the stock falls with the market. That was the price action on Thursday. Market tests support from the prior day's low, can't get through it. Now they try the upside, struggles to get through VWAP, and then blam, we get some late day selling. This was your entry point on the trade when the SPY took out the low of the day and it took out the 100-day moving average. Put up the daily chart, take a look, and there you can see that price action on Thursday when we took out the 100-day moving average. All systems go, market is breaking down, volume is pretty heavy. It's go time, folks. Look at that volume starting to pop up. During this initial breakdown that we had on Thursday, you can see that the volume came on that drop. On this drop right here, you could see on the new low of the day, the volume came in, and that was your opportunity to short MicroStrategy. It fell from roughly about $255, $256 all the way down to about $240. That's a nice $15 move on that stock. Really good profits to be made. So where do we go from here? Well, I'm going to give you a little bit of flavor of what transpired last week and some of the commentary that I had in the chat room. So first of all, as I've been mentioning, the economic backdrop globally is starting to crumble. It's been that way for many months. Domestic economic releases have remained fairly strong, but we are starting to see some weakness here in the US. That's why we've been favoring the short side. In fact, on that Wednesday video, I was tempted to maybe sprinkle in a long position because I knew that the market was setting up for a bounce. But then I said, no, I'm not going to do that because I'm going to have somebody in there trying to anticipate the bounce instead of waiting for it. and they're going to get long, and the market is going to have another big leg lower, and then you're going to be stuck, and you're going to ask me, what should I do with this long position? It's losing money. You're going to stop out, and you're going to lose money on it. So I thought, nah, I'm not going to get cute with this. I'm just going to give you a short to focus on. Very, very important. Even though the market's bouncing back and forth, if you're not a professional trader, it's fairly tough to navigate the market, and you don't want to be playing these wiggle and jiggles. You want to be favoring one side or the other. And right now, the side that you should favor is the short side. When you get the big drop, you take your gains, you expect a big bounce, you wait for that bounce to start to stall out, and then you re-enter your short position. You never lose focus of the short side, because that is where you're going to be making your money. That is where the trend is. So let's go into the daily chart just to show you what's shaping up here. So the market barely makes a new all-time high about 10 days ago. And then we get this long red candle off of that relative high. Warning sign. We get a tiny little reprieve in here, and then they went after it with gusto this week. And you can see how we had poked at the 100-day moving average. I was starting to think, we've tested the 100-day moving average 3 times now. We should be getting that bounce right here. If we can't make some progress Thursday afternoon to the downside, buyers are going to start to get emboldened, and they're going to bounce the market. It's not what happened. That final poke took out support on Thursday, and then the programs kicked in. So on this breakdown here, you had traders buying dips, buying dips, buying dips. Once you've got a support level like this established, then buyers take comfort knowing that, hey, there was horizontal support there before. There were buyers here before. I'm going to buy here, and then I'll have unlimited upside to the trade, and I'll keep my stop tight just below this horizontal support. So I've got limited downside and nice upside. So now, after the third test, you've got more and more buyers lined up at this price level. And when you see patterns like this, you know that the programs are going to try and trigger those sell stops to try and flush them out of the position. Whoosh. That's what you got on Thursday. Now, typically, you're going to get a nice big bounce Thursday, and you're going to go right back into the range and right back above the 100-day moving average. End of story. That's not what happened. This is when the programs started to kick in even heavier. So if you are short up in here on this fail, that's great. You can stick with the position, even add to it on the next leg down. But the programs started to feed on themselves, and this turned out to be a very nasty drop on Thursday. If buyers were engaged, if buyers were excited to get long at the 100-day moving average, you would not have seen this type of decline. Were buyers interested? What would be signs that buyers were interested at the 100-day moving average? Heavy volume? Yeah, that would be one thing. Stacked green candles off of the 100-day moving average? Boom, 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 higher? Yeah, that would be a sign that buyers have said, we tested support 3 times. I like this support. Let's buy them. That's not what happened, and you would not have seen this level of selling pressure if buyers had their bids layered around the 100-day moving average, because the market would have tested it and boink, it would have bounced right off of it because buyers were there. Buyers were aggressive. When you flush out that support level and you get follow through, it tells you that the buyers really aren't there. They're not excited. So now we come into Thursday, and we had this initial sell-off with a bullish engulfing candle. Okay, second bar of the day looks pretty good, and then we've got this wimpy bounce unfolding in here. And when I saw this check of VWAP in here and this instant long green candle, I thought, we might have enough here for the market to move higher. And This was mixed overlapping candles. The volume was light. There really wasn't anything to hang your hat on. But I felt like, yeah, we had a bullish engulfing candle here. We had a bullish engulfing candle here. I'm going to get long in here, S&P futures. And this is enough to maybe get buyers excited to where that support level at the 100-day moving average is going to start taking hold, and we should be able to gradually grind higher. That's not what happened. We had a lower high double top, and on this drop in here, I took a 10-point loss. I went, you know, when I was in the trade right here, I needed to see long green candle, long green candle, long green candle very quickly. This could not take an hour to unfold because that would tell me that buyers are not that excited. I need to see that buyers don't feel that they are going to have a better opportunity to buy this market than right here and right now. And they get the confirmation on that long green bullish engulfing candle off of VWAP. Boom, boom, boom. Let's flush out those bearish shorts. Let's make a new high of the day and let's go. That's what I was looking for. It needed to happen within 2, 3, maybe 4 bars. I needed to see that new high of the day. I got this little pullback, whoosh, pull the plug. That's it. I didn't get what I wanted. Okay, so in this environment also, it's very difficult to trade S&P 500 futures because they move all over the place. It is so much easier to trade stock, and that's why all of my videos feature stock and not S&P 500 trading. So as the day starts to unfold, we get back down to this low, and now it actually does look like the market is going to take out that low. We're making steady progress to it. We have heavy volume during this decline. I made a mistake. I took a starter short position right about in here. And then I had it fly right back in my face, right in here. And I went, oh, okay, that's a sign. Big, long, bullish engulfing candle. That bounce is setting up. So the market tests VWAP, and I'm not as afraid of a few long red candles as I am nice, stacked, normal size, consecutive green candles. I would prefer to see that setup because that is a sign of persistent buying. Just like this was a sign of persistent selling, that type of bounce here would be a sign of persistent buying. So we test VWAP, we come down with a long red candle. Uh-oh, here we go. Maybe we'll test the low of the day. Nope, we made a higher low, double bottom, and this is when I said, you know, I think this is going to attract buyers. I'm going to buy some SPY out of the money calls. I bought the 395 calls that expire Monday, March 3rd. I bought them for $1.35. I think I said 395s, but it was the 390 calls that I bought. And you can see off of this low right here, the SPY at the time was at 385. And so I thought there's a good chance we're going to get an afternoon rally here. And the bounce that I've been waiting for looks like we've got enough signs of support here that buyers aren't just completely throwing in the towel. Long green candle, bullish engulf, long green candle off VWAP, bullish engulf, long green bullish engulfing candle off of the low. Absolutely gets right back through the open of that long red candle. All right, I'm feeling pretty good about this. So what happened? Oh, look at that rally. I ended up selling my 590 calls for $4. I made a 200% profit on them. The whiff that I had earlier in the day for 10 S&P points, the whiff that I had here for about 22 S&P points, both starter positions, both were way overpowered by the amount of money that I made on those SPY calls. So the point that I'm trying to make is that the market's not going to go straight up. It's not going to go straight down right now. There's a lot of chop. Bull markets die hard. We're still waiting for that economic news to come in, and it's coming in dribs and drabs. And so what did we have last week that looked problematic? We've had all sorts of numbers coming in from Europe and from China. I think China is a complete mess. You can't trust their numbers, but they are definitely seeing signs of economic weakness. Here domestically, one of the bigger pieces of news that came out late Friday was that the Atlanta Fed now believes that Q1 GDP, when it comes out, it's going to be minus 1.5. That's a big deal. Negative growth in Q1 is a big deal. We saw the jobs report come out at 140K a month ago. That was the first week jobs report that we've seen. Thursday, we had initial jobless claims come in at 246,000. Boom. That was a nice little spike higher. So we've got Trump promising that he's going to be instituting tariffs, I believe, on March 4th. So we've got that news for the market to kind of try and shoulder. We have a big drop in consumer confidence. So that's already telling us that consumers are starting to pull in the reins. And this is consistent with all the earnings reports that we've seen, especially when it comes to retail and restaurant. People are cutting back their expenses. We're starting to see credit card delinquencies rise. I've mentioned all of this, okay? Know that the macroeconomic backdrop is deteriorating globally, and it's starting to show up in the US as well. We got the flash PMI numbers that I referenced in last week's videos. Flash PMI for the services sector came in at, I believe it was 48.6. That is a huge drop. And we've got ISM services coming up this Wednesday. ISM services has been pulling back in recent months. It finished in expansion territory at 52 last month, but it had pulled back substantially. And with that low reading that we got in the flash services PMI number, ISM services on Wednesday could go into contraction territory. And given what the Atlanta Fed sees happening for Q1 GDP, I think the table is set for some higher unemployment numbers this week. So we've got ADP coming out on Wednesday. We have the JOLTS number coming out. We've got the unemployment report itself coming out on Friday. It's going to be important to see where jobs come in. If they're well below 150K, if they come in at 100K, that is going to be poorly received by the market. I don't think the market's going to like that at all. Why? Well, the main reason is because the Fed is somewhat handcuffed right now. They are seeing inflation tick higher, and one of their mandates is to make sure that they are controlling inflation. And last month, we saw a 0.5% increase in hourly wages. That's huge. So we got to watch that hourly wage component. If we get 100,000 job growth this month, in this reading, and we see wage inflation of 0.4% or higher, the market is not going to like that combination, because the Fed has already voiced their concern with higher inflation. And so now you combine economic softness with a hawkish Fed, and investors are going to feel that the Fed is going to wait too long before they ease. And right now, the market had been expecting a June rate cut. And the Fed's already said, we were thinking 4 rate cuts in 2025. Now we're thinking 2. Central banks around the world have been cutting rates. We are one of the only central banks that hasn't recently cut rates. Those foreign central banks see the inflation problem, but they are much more concerned with the deterioration in economic activity that they are seeing, and that is why they are cutting rates. So that's what's in play this week, and you've got a nice, big, tall, huge bounce like this that absolutely destroys shorts. So one of the key things that you have to know is that bear markets behave differently than bull markets. And what you tend to see in a bear market is you're going to see nice, big, deep drops of, say, 5% or so. But once that drop runs its course, you have to take profits. You cannot wait for the low to show up because you're going to get moves like this. And this unfolded in the last 2 hours of trading. The S&P 500 moved 100 points. That is, you've got to stay out of those situations. So we're going to let this bounce run Monday and Tuesday, and then we're going to be watching for signs of resistance. So let's set the table on a longer term basis, because you know from my analysis that I have been looking for a market decline. But because bull markets die hard, we're not going to trade what we think. We are going to trade what we see. And that philosophy kept us out of trouble when the market just made a new all-time high last week, 2 weeks ago. So we weren't getting our head handed to us because we had this bearish outlook. We're waiting for the numbers to come in. We're waiting for that technical breakdown. This type of heavy selling pressure was exactly what I've been looking for. This is the tell. The time has come. So now what do I want to see? Now I want to see us struggle, struggle, struggle. You can see how we got through the 100-day moving average on Friday's close. I want to see us struggle, struggle, struggle for the next 2 or 3 days to get through that 50-day moving average and not be able to. If I see that type of resistance, that will be the lower high that I've been watching for. And one thing you'll also notice is now that we've been in this sideways trading range for the last 3 months, the moving averages are starting to converge. Okay, they're getting narrow. See how wide they were right in here? Now they're starting to converge. Well, what does that mean? Well, it means it's a lot easier for us to test those major moving averages. We don't have to move that far to get down to the 200-day moving average. We're right there. So nice little wimpy bounce. Let's say that, for the sake of argument, ISM services comes in just fine. ADP, a little soft, but looks okay. The jobs report on Friday, okay. Maybe they come out at 150,000 jobs and hourly wages are up 0.3%. That would be all acceptable. Okay, that's going to still keep buyers relatively engaged. In that scenario, what you'll see is that this bounce will last just a little bit longer and a little bit longer, and it might extend out. Instead of 2 days, maybe it takes a week and a half. And then the market starts to kind of flatline around this 600 level. I really don't want the market to get much higher than that, because if it does, then it's going to tell me that buyers are still interested and they still have some say. So I really want to see that resistance at 600, because that tells me that longer term money is nervous, very nervous, and they are keeping a lid on this rally. Why and how? How is this happening? What do you mean keep a lid on it? They keep a lid on it by having their sell orders there, because they want to reduce risk. They don't want to panic sell, but if by chance the market rallies back up to the 600 level or that 50-day moving average, at that price, they feel this is a good place for us to reduce risk and reduce risk. And no matter what buying comes in, it's just not enough to break through that level, because there are too many sellers. And that type of resistance forms that lower high double top. And that sets the table for a beautiful, wonderful entry point for short positions on the notion that the next leg lower is going to obliterate the 100-day moving average, and in all likelihood, test the 200-day moving average and perhaps even breach it. And once that happens, it is a shot across the bow, and all asset managers take notice and they go, uh-oh, didn't expect that. And they've also got lots of economic data points that tell them that things are starting to soften up, which, by the way, cash levels for asset managers at lows that we haven't seen since 2010. What does that mean? It means they're super bullish. It means there's no dry powder for them to fuel the market higher. They're all in. All the chips have been pushed out on the table. So that means that when you get dips, those guys who are in there constantly buying dips, buy the dip, buy the dip, buy the dip, buy the dip. There's no cash left to buy the dip. So the pullbacks are deeper and more prolonged because now asset managers, instead of buying dips, are like, I don't have any cash to put into the market anymore. I'm fully deployed and the market keeps pulling back. I have to reduce risk. And then that starts to feed on itself. So very typical for a long-term market trend to go into a horizontal trading range to start seeing these major moving averages converge, and then eventually you get your technical breakdowns. And that's why it's very important not to short the top, not to trade what you think, but to wait until you see that technical weakness. And this told me there is technical weakness. We did not bounce off the 100-day moving average like we have previously, like we did there, like we did there, like we did there, like we did there. Okay, that's typically how you get off of those 100-day moving averages. So what do we do now? Well, I think there's going to be a little bit of a bounce Monday and Tuesday. Don't get cute. I will show you one stock that I'm in, and I'll show you why I like it. But this is for day trading only, and it is for professionals who will know not to overstay their welcome. For the other 90% of you, only keep your eye on the short side. And do not try and get cute, because as soon as you try and squeeze in a long or two in here, you're going to overstay your welcome. You're going to lose a ton of money on those trades. And when you're worried about, oh my gosh, my bullish positions are going to shit, you're going to miss all those beautiful short trades that you should be focusing on. So I like SOUN, and I'll show you why I like it. I liked it because you can see the post-earnings reaction was right here. The stock opened flat, so analysts that looked at the number went, I like it, that's a good number and everything, but we didn't see a big gap up in the stock. But what we did see is some very, very aggressive buyers recognizing that this was a decent number. And look at these stacked green candles. Absolutely relentless. The stock goes from $9 to $11. It's like a 20% rally in the underlying stock. And on Friday, when the market fell apart, what did the stock do? Well, let's put up the SPY overlay, and you can see how the market absolutely got annihilated in here before it bounced. What did the stock do? It held all of these gains, it tested VWAP, and then when the market rallied, it got right back to the high of the day. Full disclosure, I'm long that stock at $10.69. I will probably ride it Monday, maybe Tuesday. It depends on what I see in the overall market. So again, I'm looking for resistance around that 600 level, around that 50-day moving average, and I plan to be out of the position Wednesday morning before that ISM services number, before ADP are released. I'm expecting weak economic data points. I want to be positioned on the short side. I don't want to worry about any freaking longs that I have out there because I'm just playing an oversold bounce. So I plan to be fully in cash Wednesday morning, and I will have all of my bearish picks lined up and ready to go. So I'm going to give you a bearish pick, and that is what you should be focusing on. And then I'm going to show you one stock and the types of patterns that you should be really hawking and waiting and setting that trap. FSLR was on my red royal flush search. I shorted it here on Thursday. Dang, was that a nice trade. Post earnings, I got out here. I didn't have time to watch the position. I had so much else going on. So I closed it down for a nice gain, but I know that a lot of members in the chat room got on FSLR. There's your earnings reaction right there. You can see how the stock initially gapped up, but what did we see after that earnings announcement the next day? A gigantic bearish hammer. So they tried the upside and it got smacked down. Then what did we see Thursday? Oh, the stock had weakness right away, and it was filling in this gap right in there, and that's when I got short. Now, stock did not rebound much on Friday, so it tells me that sellers are still nearby. So remember that big market rally that we had? Well, the stock barely got off the deck. So what do I want to see Monday and Tuesday when the market bounces or tries to bounce? I want to see this stock struggle to recapture that high from Friday. So if it takes 2 or 3 days, and let's call that 141, I think is probably a good level. Yeah, 141 works. So I don't want to see the stock get above that level. I want to see it struggle, and then the market pulls back and the stock pulls back right away. Then the market recovers and it continues to move higher, and the stock just struggles to get back up to, say, $140. If I get that pattern, then I'm going to know that sellers are still nearby because they hate FSLR, and they hated the earnings, and they hate the prospects for next quarter, and they are keeping a lid on it, and they are selling as much as they can, and that's why the stock can't rally with the market. I'll also be watching for the market to hit resistance at that 600 level. If ISM Services comes out Wednesday morning and the market reacts negatively to that and ADP, then I'll be watching for an entry point on FSLR on the short side. That is how all the pieces come together. When you are trading, all the tumblers have to line up before the door opens. And it's about check boxes, and it's about probability, and it's about odds. And if you don't have everything lined up, you don't do the trade. But when everything does line up, it's a thing of beauty. So that's how I see the market playing out this week. Lots of economic news coming up. It's going to determine future market direction. And if it's weak, as I suspect it might be, we're going to get a very short bounce and then another big wave of selling. And we're going to wait for that news. We're going to wait for that breakdown. If you're looking for some levels to watch, if we get above the 50-day moving average, which I don't believe we will, a crackdown, an easy crackdown back below the 50-day moving average, that gets you short with your starter. Then an easy crackdown, because they're so close together below the 100-day, that's your second add to the position. So you want to be adding to the position. You don't want to just take a position. You want to add to the position. And as you start to get more and more follow through, and we start to bite into more and more of this long green candle right here, you add to the position. Most definitely you take out the low from Thursday, you add to the position, because then you're quite confident that the next test is the 200-day moving average. And if we free fall down to that level, we're going to be looking to take gains, because we know that these big market drops tend to have some pretty violent bounces just like that. So into that deep, heavy selling pressure, that's when you got to take your profits on these trades. Then you wait for the bounce and you reload. That's the mode we're in right now. We couldn't quite be sure, so we were day trading from the short side in here until we had confirmation of this heavy selling pressure. Now we've got that component. Now we've got the bounce that we're waiting for. We're waiting for that stalled bounce, and when that bounce stalls at that 600 level, now finally, gosh, we've been waiting for 2-3 months for this opportunity. We're finally going to be able to take some bearish swing short positions. It's been a while. We've been patient. Everything tells me that the next decent size market move is going to be on the short side. So if you get cute and trade the long side Monday and Tuesday, be very, very, very careful. Know that if the rug gets pulled out from under you, you're an idiot, because you should have been focusing on the short side and doing nothing Monday and Tuesday except for watching and monitoring stocks and getting your shorts lined up is absolutely the best possible way for you to spend your time. And I'll give you an example of Google, which has been one of the shorts that I really like and the type of pattern that you should be watching for. When you have a stock that's broken down below a major support level, like a major moving average, like the 50-day or the 100-day or the 200-day, you've got a nice clean breakdown in Google here. Market starts to rally. It gets back up to, say, 600 or so. What does Google do? It struggles to recapture the 100 or the 200-day moving average, the black line, and it can't get above that level. And the price action on the way up, when you've got nice big market movement, nice big rally through the 100-day moving average, what did Google do on Friday? It barely even got through the prior day's high. So it just mixed overlapping choppy candles, not a lot of volume, no boom, 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 no big rally in this thing. That tells you that the stock is very tired and that sellers are still nearby. And it's not just Google, it's all the other stocks. Look for those big breakdowns below major support levels, below major moving averages, and that sluggish, wimpy attempt to bounce with mixed overlapping candles and light volume when the market is bouncing. You want to see that type of relative weakness in the stock, because that's the tell that when the market finally cracks and rolls over, that those stocks are going to be ripe for the picking. Thanks so much for watching, everyone. Trade well. Make sure to subscribe to my YouTube channel. Please give the video a thumbs up. It's going to help me reach a lot more traders. And turn on your notifications, because I'll be doing a short video this week with a pick. I don't know when I'll have time to put it out, but if you got your notifications on, you'll never miss a beat. Thanks again. Trade well.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.